What are you thinking about as this story unfolds?
Yeah, I'm kind of on Josh's side with the idea that this is a huge event, and the headlines are horrific. I mean, it reminds us so much of 2007. But I think when we frame it appropriately, Scott, this is a unique situation in that the bank really focuses on a very defined segment of the population. And crypto and pre-IPO markets, they're not the same as the national housing market. Also, one big difference between the early 2000s is the market capitalization rate. The bank capitalization standards are much different, much stricter. I'm not saying they're perfect, but I think that this is something that might not be bleeding out into all of the various financials. So we own Goldman Sachs, we own JP Morgan. We're going to hang in there with those positions. It might not be an isolated event, but I don't think that this is the next catalyst for a financial and banking crisis.
Does it make you, the story itself and the uncertainty that it helps create, does it make you less inclined to want to put new money in the market?
No, I think I'm less. We've been talking about this for 14 months. I think I've been somewhat less inclined for quite some time. But the reality is that we're going to see pullbacks, we're going to see volatility, and when we have weakness, I fully intend to put that money to work. You may want to be a little bit more patient with the financials, because even if this doesn't bleed in, there's still other factors facing the broader financials that you just want to be cognizant of. When you have super high short-term rates, I mean, you can walk into any bank and get 4 or 5% in the money market. That affects their net margins. Also, the byproduct of what happened at Silicon Valley when they had to liquidate their book, you have all of these 10-year treasuries that are going to market, and usually banks don't have to sell them. They don't have to market to market. So that's something that we have to look at to make sure that other banks are more capitalized than maybe they thought they were.
What's pretty interesting to me is you reinstated a position I see in Apple, which you had called away about a month ago, and this is happening when we get a downgrade today to a sell over at Lightshed. Walt Piecyk, he's been around the way for a while, covering the tech industry, but he takes Apple to a sell today from neutral. Target goes to 120. Why the new buy?
Well, I don't know that I'm that pessimistic on it, although the last time we bought it before this week at 146, and this was just about 2 months ago, we did buy it at 126. So 120 is not out of the realm of possibility. But for us, we're looking at the next 3 to 6 months, Scott, as an opportunity to build out positions. None of us can time the market, but we can pick the stocks that we invest in. And if we're looking at this next 1 to 2 quarters, 3 to 6 months, as volatile, choppy, I mean, the bear has front and center stage. We at least want to get our foot in here, start building out our positions. And if we can get it at 120, that would be fantastic.
Yeah, I see you also bought more UPS at 178. Tell me about that one.
We've had that called away twice recently, very similar to Apple. It was a position we were out of. First, we had it called at 207. We got back in, had it called at 186. We started to get back in. Again, it's a scenario where we're looking for companies that have good revenue, earnings, dividends, dividend growth. And these are stocks that are small positions that will build out. And I think that's what the viewers, the investors need to take solace in, is that volatility gives us opportunities. And when we have pullbacks in the market, it's not a time to be fleeing or running for the doors. But if you're looking for a 3 to 5 year window of really good companies, low multiple, strong earnings, great dividends, you can build positions exactly the same way that we do it.
All right, we'll talk to you soon. Kevin, thank you. That's Kevin Simpson.